The S&P 500, aka the holy grail of investing. Now, if you clicked on this video, you more than likely fall into one category of individual. The first is either you're currently invested in the S&P 500 or have previously invested in the S&P 500. Or you're person number two who is just getting introduced into finance and some friend, family member, some YouTube guru, someone has told you how the S&P 500 is one of the best and safest investment vehicles. Regardless of what category you fall into, whether you're new to this stuff or you're a seasoned investor, I just want to go over this thought process I had recently on this thesis of why I believe the S&P 500 is actually more of a savings vehicle than an investment vehicle. So, regardless of what your opinion is now, I hope whatever you find in this video can be somewhat insightful and have you thinking a little bit differently of where the S&P 500 falls within your actual portfolio. So anyways, I digress. I'm just here on the Wealth Simple page, and I'm just gonna go over quickly what actually is the S&P 500, just for those who aren't really familiar with it, and you're just kind of exploring, and you just clicked on this video, and you don't know too much of what's going on. So anyways, I'll quickly skim through this here. The S&P 500 is a stock market index that tracks the performance of 500 of the largest publicly traded US companies. So it goes more into depth how you can invest in it via a mutual fund or an ETF, because the S&P 500 is inherently an index, so you can't just invest into it directly. You need an ETF or mutual fund. And interestingly, here I go down here to the benefits, right? And there's a few things here that are interesting that I want to point out. It says diversification, ease and convenience, and performance. So these two are very interesting, and more specifically, number three, performance. So this is going to be key to why I go over this is actually a savings vehicle and not an investment vehicle. But one interesting point I do want to point out here is diversification. I don't want to ramble too much into that right now, but I do just want to point out that the S&P 500 is really just the S&P 493 plus the Magnificent Seven, because you could just see from this graph here, about 36% of the S&P 500 is actually made up of the Magnificent Seven, which is everyone's favorite tech stocks that include Nvidia, Apple, Tesla, Google, Meta, that kind of bucket that probably most of you are either invested in already, or you've probably heard or use any products of this company. So without further ado, though, let me continue and get back on track. So here I have savings versus investment definitions. So I think this is important for me to bring up first, just the general definitions of these two words. So savings is the act of putting aside money in a safe, easily accessible account for short-term goals or emergencies, emphasizing security and liquidity. Whereas investing involves using money to buy assets like stocks or bonds with the expectation of generating returns and building wealth over the long term, which carries more risk but offers a higher potential for growth. So essentially what they're saying here, what my definitions are based on these definitions here, is that savings is essentially a way to preserve your liquidity. So you're just preserving your liquidity for short-term goals, or you need liquidity. You don't want to invest, which is where you actually grow your wealth. But the reason why most people don't quote unquote invest and they would rather save is because of the fear of the higher risk, but the higher potential for growth. But people like to separate them. So anyways, I digress further. So we have a basic understanding of what savings versus investing actually means. And basically savings is the preservation of the liquidity. And I'm going to go into why the S&P 500 actually falls under this category and not actually this with the higher potential for growth. So we go here to the chart. So here is a logarithmic chart of the S&P 500. And if you take a look at this, you're probably thinking to yourself right now, what is this guy talking about? This chart looks beautiful. I mean, if you invested your money into 2000s and you held all the way now in an ETF or mutual fund, you're up about 341%. So, I mean, that sounds like an investment, right? I mean, you put in your money, you grew wealth over time, and it was a fairly safe and stable ride. I mean, the declines we had, there were big drops over time, but those were quickly flushed out as long as you held for the long term. And when you look at this chart, you're thinking, yeah, this is definitely an investment, not a savings vehicle. But the problem is this chart is denominated in US dollars, which is a little bit problematic. And I'm going to explain to you why that's the case and how this can probably shift your perspective a little bit. So the next chart that we're going to look into here is actually the M2 money supply chart. And what you can notice here is this chart is just going up. Let me put in the logarithmic here. It's just constantly going up. In fact, it looks pretty similar to the S&P 500 chart. I mean, if we kind of shift back and forth, I mean, they look almost identical. We have kind of this parabola effect going on here, where these kind of decades were kind of more flat, but still had a growth. And then we had this big parabola, almost the same thing here. But before I continue rambling here, the M2 money supply, just for that people don't know what it is, it's a measure of the money supply that includes cash, checking deposits, and non cash assets that can easily be converted into cash. So, in other words, this is all the liquidity that is in the US market. So, the US dollar, this is all the liquidity, all of the cash instruments. That what is this number that you get to? This $22 trillion. So now that we have kind of a basic understanding that this is all the liquidity, all the cash that exists, if we kind of go back to this chart, I'm just going to overlay this here. So let's just overlay this chart. And again, we can see almost the exact same thing. I mean, we could play around with the scale. Of course, it's not one to one, but again, you see this parabola effect. You see the same thing where it's kind of still trending up, but then exponentially has like this end parabola to the last few decades. So you may be asking yourself, why is this important? Why am I talking about this? Because what this inherently shows is the amount of liquidity that's being injected into the system, causing an abundance of inflation. So the reason why the S&P 500 keeps going up, it's not necessarily the narrative about, the Magnificent Seven and all the great technological advancements in the US, but it's more actually because of this M2 chart with the amount of liquidity that's being poured into the market. And as the S&P 500 is the 500 top companies and the most widely accessible investment vehicle that most people turn to, that's quote unquote safe, naturally the liquidity is going to flow into there, causing this basically mirroring effect where the more liquidity that gets pushed in, the more the parabola keeps going up. So let me digress even more here. So an interesting chart that I've been playing around with is actually this chart here. And what this is the S&P 500 divided by the M2 money supply. So instead of denominating the S&P 500 in US dollars, we're denominating it in the M2 money supply, meaning we're basically measuring it in the total liquidity of the US market in its dollar. So when you put this chart overlaying like this, you notice something very different. It doesn't have that same parabola effect. The gains look a lot more subdued. And interestingly enough, when I made that same comparison here, let me just delete this. When we make that same comparison from if you bought at the top of the dot-com bubble, for example, you would have been up 350%. But if you look at this chart here, you are actually kind of down a couple percent or more or less the same level. So you may be asking yourself, why is that the case? How does that make any sense? And that just comes back to, again, the M2 money supply increasing the liquidity, because if you look here, the value of the S&P 500 in this time period was around 1400. But if we look at the amount of liquidity that was here, we're talking about $4.5 trillion. So the S&P 500 went up 350% with 370% within 25 years. But the M2 money supply, which also is inherently the inflation, has went up almost exactly the same amount. So what you're actually seeing here is you're just seeing this being a byproduct of the inflation. And I can prove this even more with something called the shadow government statistics. So, for those of you that don't know, CPI, which essentially measures the inflation that's reported, um, essentially what happened here is their methodologies essentially changed in the 80s. And this is the reason why, when you look at the CPI inflation graph, the official ones, you notice that over the past couple decades, they're usually around 2%, 2.5%. We did, of course, in this recession have a bigger jump. But regardless, we see that in the official stats, this one is cut off a little bit. This is only goes up to 2023. But regardless, we can see that apparently inflation is going down. But the thing is, it's not going as down as much as you would think, because day to day, you could probably see it yourself. You don't need to look at these stats or these graphs. You can see that life is getting a lot more expensive when you go to the grocery store, when you're just shopping, things of that nature. It just becomes a lot more expensive. So, anyways, what's going on here is, instead of taking the actual CPI reporting, which is historically 2.5%, I'm going to take this shadow government statistic, which measures it the same way before they switched in the 80s, and the average is more around 6% instead of 2.5%. So if we go over to the inflation calculator and we have $10,000 and we're going to do an inflation rate of 6% after 25 years. So this is the equivalent of putting $10,000 in the 2000s and waiting 25 years. If we do that, calculate that, we're going to see that $10,000 then equates to about $42,918. So $43,000 of today's money is needed for the equivalent of 10,000. So that's more or less the same. If you take $10,000, invest in the S&P 500, you're sitting at about $34,000. Now, of course, this is kind of a little bit of an arbitrary number. We could play around with this. Say inflation rate is closer to 5%. We could calculate it, and then we get closer to that number. And what you're going to notice is that despite the $10,000 growth that we see in here in the S&P 500, it is actually hasn't moved at all. In fact, it reflects more closely to this chart, where we are actually in the same or less amount than we were 25 years ago. So the moral of this story that I'm just trying to preach here, like, I'm not saying I'm a technical analysis guru. I'm not saying I know everything and that I'm some market wizard, but all I'm just trying to say here is that through my observations, what I can see is that the S&P 500 just moves with inflation, and it's actually more of a savings vehicle to help you maintain your liquidity, preserve what wealth you have, and that's all it's essentially used for. It isn't used for you to gain wealth and to increase your net worth necessarily. Your net worth will increase in terms of dollars, but in terms of actual inflation and the M2 supply, your net worth stays the same, as we can see here from this graph. So at the end of the day, all I have to say is I'm not saying don't put your money in the S&P 500. This just proves that this preserves your liquidity over time, and that as they keep printing more money and devaluing the US dollar, it is just naturally going to also increase the S&P 500 and preserve your money. So at the end of the day, this is just a different perspective I'm trying to offer. I'm not trying to, say the S&P 500 is bad. I'm not trying to say the S&P 500 will make you rich. But what I am saying is this is the part in your portfolio that will actually preserve your savings. And I do think it belongs in everyone's portfolio in some way, just because of this quote unquote almost guaranteed that it keeps up with the liquidity of the M2 money supply. So nonetheless, thank you for watching. If you enjoyed this video and you made it all the way to the end, I'd appreciate it if you guys would subscribe, like, and also comment, what was the most interesting part of this video, or what's some other topics that you would want me to explore more. I'm just kind of rambling here, but this is just a very interesting chart I just kind of stumbled upon, and I thought it would be interesting to talk about. So anyways, if you're seeing this today or in the new year, Happy New Year. I appreciate you for watching, and until next time, take care.